welcome to JKSC classes, Inter CA November 2021 revision lectures. Financial management subject we will be revising. In this video, we will be picking up the chapter of capital budgeting. Now children, what is capital budgeting? Capital budgeting is all about an investment decision, correct? It's an investment decision chapter, whether or not I should accept a particular project or an asset. Everyone clear? Or this particular chapter can also deal with a decision. If I want to choose one of two, then which one to choose, right? Project A or project B. So the first type of decision was accept or reject. One project or one machine will be given to us, one asset will be given to us. We have to decide whether or not to accept that asset or that project. The other decision making was two assets or two projects are given to us, which one to choose. The first one, children, is called as accept reject type decision. The second one is called as mutually exclusive projects given to us, and we have to choose any one. Then children, if we go deeper into this chapter, there is one more decision making called as replacement decision. Replacement is all about we already have one existing asset and few years are still left for that existing asset to run, but we are thinking whether or not to replace this existing asset with a new one. And of course, the life of the new machine will exactly be equal to the remaining life of the existing machine. So a decision has to be taken whether to replace the existing machine with the new one, or should we continue with the existing one. So children, these are broadly speaking the three decisions you have to take in this chapter. And of course, there are some sundry areas also. But you should know that to take these decisions, there are certain techniques given to us. Now children, what are these techniques? There are in all 7 capital budgeting techniques. First is payback period. Second is ARR. Third is net present value. Fourth is profitability index. Fifth is IRR, internal rate of return. Then sixth is discounted payback period. And seventh is modified IRR, MIRR. So children, let us just go through all of them one by one, and then children will pick up the sums and knock them off. Let's start. Okay friends, now let's understand these techniques one by one. The first technique is payback period. You remember this payback period. What is the meaning of payback period? Payback period refers to the time taken by the project to recover the initial investment. Do you remember? Time taken by the project to recover the initial investment. So basically children, if I've invested 1 lakh rupees in a project, how fast this 1 lakh is getting recovered, that period is called as payback period. Now if there are two projects A and B, the payback period for project A is 3 years, payback period for project B is 4 years. According to payback period, we will select that project obviously whose payback period is lower. Everyone remembers this? In payback period children, there were two cases. One case, the first case is if the cash inflows are same every year. The second case is if the cash inflows are different every year. If the cash inflows are same every year, then payback period has to be calculated as initial investment in the project divided by annual cash inflow. For example, children, your initial investment is 1 lakh and the project is going to give you 25,000 same every year per annum annuity at the end of every year for let's say next 10 years. So children, I will divide 1 lakh by 25,000. My payback period is obviously 4 years. Everyone clear? But children, if the cash inflows are different, then we will have to do the table of payback period, that is year, cash inflow and cumulative cash inflow. Everybody remembers this? Then in year you write down 1, 2, 3, 4, 5, 6, how much ever years are there. Then you note down the cash inflows. And then when you cumulate the cash inflows, you will realize that payback period, okay, payback period, it lies between 2 years, right? Let's say between years 3 and 4 or 4 and 5, whatever. And then you have to do the interpolation. Interpolation means, children, if in one full year we are getting this much cash flow, then to recover the balance cash flow, how much part of the year, that children will give you that interpolated amount, and with that you will be able to find out the payback period. I am not going into details here children, it's a revision lecture, so I hope you remember this payback period also. Everyone clear? So with that we complete the discussion to payback period. Let us now move on to the next. The next one children, the second one is ARR, average rate of return. Some call it as accounting rate of return because this is the only technique that takes accounting net profits, of course expected, but accounting net profits into consideration rather than cash flows. There are two formulas. Formula 1 of ARR is ARR is equal to average net profit after tax upon initial investment into 100. Average means, children, simple average, okay? So if 5 years NPAT is given, so add all the 5, divide by 5, simple average NPAT upon initial investment into 100. And formula 2 is ARR is equal to, children, formula 2 is to be applied only when salvage is given in the question or working capital is given in the question. It is average NPAT, same numerator, upon average investment, not initial investment, into 100, where average investment is equal to initial investment minus salvage divided by 2, the whole plus salvage plus investment in working capital or current assets. Everyone clear? So children, these are the two formulas of ARR, and for the second formula, denominator, this is the formula. Everybody got it? So with that, children, we complete the discussion to the second capital budgeting technique. Now moving on to the third. Now the third technique, children, is called as net present value. Okay, net present value, very famously known as NPV. See, the previous two techniques now, they were called as non-discounting techniques because their time value of money was not taken into consideration. But from now on, the remaining 5 techniques are called as discounting techniques because time value of money is taken into consideration. NPV, how to solve? Very simple. NPV is present value of cash inflows minus present value of cash outflows. A project is given to you. Whatever cash inflows that project will give, relevant cash inflows, calculate the PV of it, that is PV of CI. Whatever cash outflows will be required for this project, most importantly initial investment, present value of the same, please note it down in PV of CO, and PV of CI minus PV of CO will give you NPV at whatever rate you have done the discounting. Everyone clear? And what is the rule? The rule is if NPV is positive, then accept the project. If NPV is negative, then reject the project in case a single project or a single asset is given to you. But if two mutually exclusive are given to you, then children, what to do? Do you realize whichever asset or whichever project has the highest or the higher NPV, we will go for that. Everyone clear? So children, this was as far as NPV is concerned, NPV technique is concerned. Now one thing I will just share with you about present value. Now in present value, children, there are 4 different types of cash flows that can come. First is a single future cash flow. Okay, a single future cash flow. Children, if it's a single future cash flow, then simply take that cash flow and multiply by discounting factor of whatever percent, whatever years. Everyone clear? Cash flow multiplied by the discounting factor. Second, if it's not a single, if it's a multiple cash flow model, okay, multiple cash flows are given. They will say at the end of years 1, 2, 3, 4 and 5, these cash inflows you will get. But children, if they are multiple uneven, okay, uneven means they are not same every year, different for every year, then children, you will have to make a present value table for it. Some people call it as a discounting table, in which 4 columns you will make: year, cash flow, discounting factor at some rate, whatever rate of discounting is there, and present value. Children, in year you'll write down 1, 2, 3, 4, 5, whatever the cash flows, discounting factors, and then cash flow into discounting factor will give you present value. This becomes the total present value of the cash flows. This table you have to make only and only when it is a multiple uneven cash flow model. But children, if it's a multiple even cash flow model, even cash flow means every year same, multiple cash flow given but every year same, we call it as annuity, right? So in case of an annuity, you need not make this whole table. You have to simply take the cash flow per annum and multiply by the annuity factor, right? Cash flow per annum and multiply by the annuity factor of R, N. PVAF, as we call it as, that will directly give you the total present value of that entire stream of even or same cash flows. Then children, fourth, it hardly comes, but I'll write it down and keep. It is called as a perpetual annuity. Okay, perpetual annuity. So perpetual annuity means every year same cash flow for eternity, perpetuity, infinity. So children, how to calculate the present value of this entire stream? Very simple. The present value will be cash inflow per annum. Okay, cash inflow per annum divided by R. That's it. Cash inflow per annum divided by R. For example, they tell you the discounting rate is 10%. Calculate the present value of rupees 100 to be received at the end of every year for eternity. So if 100 is to be received at the end of every year for eternity, the present value will be simply 100 divided by 10%, rupees 1000. That's it. Everybody clear? This of course hardly comes point number 4, but you should be well versed with how to calculate present values of a single future cash flow. Children, in single future cash flow, the best example is salvage. Okay, when you're evaluating a project, salvage is a single future cash flow. To find the present value, you have to simply multiply by discounting factor. Multiple uneven cash flows and multiple even cash flows, the best example can be of cash flows after tax, right? Operating cash flows after tax when you do for a particular project. If they are different every year, then such a table has to be prepared. If they are same every year, no need of a table. Simply you can calculate using the multiple even cash flow model, that is cash flow per annum into PVAF. Everybody clear? So with that, children, we discussed everything about NPV. Of course, a lot of more aspects are there which we'll be discussing throughout this particular video. This was the overview of what NPV is. I hope you understood it. Now moving on, children, to the fourth technique. The next technique, children, is called as Profitability Index PI. Very simple. It is present value of cash inflows upon present value of cash outflows. Done. This technique is more importantly used in a concept or a scenario called as capital rationing. Otherwise, they can simply ask you for any project to calculate PI, PV of CI upon PV of CO. That's it. Let's move on to the next technique. Children, the next technique, the fifth one, is internal rate of return, IRR. Children, if you know NPV, you almost know the IRR. IRR is nothing but that discounting rate at which NPV is 0, correct? Now this is the mathematical meaning. I'll again repeat, IRR is that discounting rate at which NPV turns out to be 0. But the actual meaning of IRR is what is the actual rate of return a project is offering to an investor, right? See, we know that if NPV at the rate X% is positive, okay, if NPV at the rate X% is positive, we know that the project is giving you a return, an IRR, which is greater than X%. But if NPV at the rate X% is negative, we know that IRR therefore is less than X%. And children, if NPV at the rate X% is 0, we know that IRR is X%. Basically, that rate at which NPV turns out to be 0 is the IRR, the internal rate of return, the return that the project is actually offering to the investor. And how are we supposed to calculate it? We are supposed to calculate it by trial and error method. Okay, trial and error method. Children, trial and error means what? Let's say we try trial at NPV of 10%. Okay, so NPV at 10%, children, let's say comes to positive 2000. So since NPV at the rate 10% is positive, we understand that IRR is about 10%. So children, the next trial we will have to do at some rate about 10% because we are searching for that rate at which NPV comes down to 0. So let's say we do the next trial at 15%. At 15%, let's say, children, the NPV drops to positive 57. Since NPV at the rate 15% is also positive, that means IRR is slightly above 15% also. Let's do the next trial, NPV at the rate 20%. At the rate 20%, NPV comes to negative 3605. Just giving example, okay? So therefore, children, if NPV at the rate 20% is negative, we realize that IRR is below 20%. And therefore, children, can I say IRR lies between, okay, 15% and 20%. Then children, the cross multiplication, you have to do the interpolation and you will be able to find the IRR. This is how you calculate generally the internal rate of return. Yes, so with that we finish the discussion of IRR. Let us now move on to the sixth technique. The sixth technique now, children, is called as discounted payback period. Children, this is nothing but a combination of payback period and time value of money. Yes, there is an initial investment which will be given to you. You have to find out how fast this money, this initial investment is getting recovered. But now not with the help of normal future cash flows, but with the help of the discounted present value of cash flows. And therefore the table you will be making is year, cash inflow, then you multiply by discounting factor, whatever percentage given, you will get the present value, and then you cumulate the present value, not the cash inflows. When you cumulate the normal cash inflows, what you get is the normal payback period. When you cumulate the present value of cash inflows, you will understand what is the discounted payback period. And of course, you will understand the discounted payback period is lying somewhere between 2 years, 3 and 4, or 4 and 5, 5 and 6, whatever. And then you do the interpolation, the cross multiplication to find out discounted payback period. So children, this was as far as discounted payback period was concerned. Moving on, children, to the next technique. Children, the last technique is called as modified IRR. Modified IRR, children, has got only 2 steps. Step 1. In step 1, we have to reinvest whatever cash flows we will get from the project at the reinvestment rate to get one lump sum, okay, to get one lump sum future cash inflow. I'll write down here, to get one lump sum future cash inflow. What table will you make? Here, cash inflow which you will get from the project, then you will compound this at the reinvestment rate to get the future value, right? Compounding means reinvesting it. And therefore, at the end of year 1, 2, 3, 4, whatever cash flows you will get, you will keep compounding so that you can get the future value at the end of life. And if you take the total of this, you will get one lump sum future value at the end of life. This I will write down as lump sum future value cash inflow. And then, children, in step 2, we will calculate the modified IRR. Okay, we'll calculate the modified IRR. What is the equation? How do we calculate modified IRR? Very simple. We know the formula. FV is equal to PV into 1 plus R raised to N. This FV is nothing but this lump sum future value cash inflow that we get. The present value is nothing but the initial investment that you are investing into this project into 1 plus R raised to N. N is nothing but the life of the project. So therefore, if your initial investment in these years has grown to this lump sum future cash inflow, what is that inherent compounding rate that you have earned? That rate, children, is your modified IRR. Everyone clear? I am not talking of this compounding rate. This is the reinvestment rate at which you will be reinvesting your cash inflows. But children, at the end, you will see that I have invested initial investment. It grew to this figure, correct, at the end of whatever years. So what is that inherent compounding interest rate that I must be earning? That, children, this R is what you have to calculate. See, children, N you know, initial investment you know, and future value you know. FV, PV and N you know. You have to find R, that is modified IRR. Everyone clear? So with that, we finish the 7th technique also. Everyone follow until here, right? Okay, students, so now that you have understood all the 7 techniques, the theory part, let's now discuss the sums, and through the sums, a lot of other areas also we will cover. So children, the first sum, as you can see on your screens, question number 1 of your JKSC book, your JKSC classwork textbook. Children, if you see in this question, they are asking you to calculate ARR. Children, for ARR, they have given to you NPAT, they have given to you initial investment, they have given to you salvage. Children, second formula of ARR you have to use. Initial investment is there and salvage is there, and of course number of years are also there. Using this, you can easily find out the average investment. And then, children, of course, the simple average of this will give you average NPAT. So average NPAT upon average investment into 100 will give you the answer for question number 1. Moving on to question number 2. So children, if you focus on question number 2, it's a basic net present value calculation. Net present value, they have given to you 2 projects A and B. Cost of capital is 12%. You can see initial investment. This is your PV of CO, right? 2 lakh for A and 1 lakh 90 for B. Then these are the 5-year cash inflows of both the projects. If you see in project A, every year the cash inflow is same. So 50,000 multiplied by PVAF, you'll get the PV of CI, and then minus PV of CO will give you the NPV at the rate 12% for project A. For project B, children, can you see multiple uneven cash flows are there? You have to make the table year, CI, discounting factor at the rate 12% and present value. Get the present value of cash inflows minus 1,90,000. You will get the NPV at the rate 12%. One thing I hope you remember, that any cash flow, whether outflow or inflow, happening today, for example, initial investment is happening today, the discounting factor will be 1. irrespective of whatever the discounting rate is, and therefore 2 lakh into 1 is the PV of CO. 1,90,000 into 1 is the PV of CO. That is 2 lakh and 190 only. Everyone remembers this, right? So children, with that we complete the discussion to question number 2. Let's move on to question number 3. So moving on to question number 3, this is a normal IRR calculation. This is your initial investment, that is present value of cash inflow. These are your 5 cash inflows. Children, do the trial and error till you find that rate at which NPV is 0. Of course, you will find one rate at which NPV is positive, one rate at which NPV is negative, and then we do the interpolation. If no rate is given to you to start with, you can start with 10%. At 10%, if NPV is positive, go to 15. If at 10% NPV is negative, go down to 5. Don't stop till you get one positive and one negative NPV, because then children, the NPV 0 will lie between these two, right? One positive and one negative. Do the normal interpolation and get the IRR for this question. Very simple, right? Question number 3. So moving on, children, to question number 4. This is again an IRR question. This is your initial investment. Life is 5 years. Now they're saying the machine will produce net operating income after depreciation. Children, which is our income which is after depreciation? This is net profit before tax. 68,000 per annum. You can easily convert it to cash flows after tax, correct? And once you convert it to cash flows after tax, this is your PV of CO 360. You have the cash inflows, right? Cash flows after tax for the 5 years given to you. You can easily find out the IRR. Now in this, children, there are two methods. Either you can do the normal trial and error method on the NPV, where you calculate NPV at different rates. They have given to you, see, 14%, 15%, 16%, 17%, 18%. PVAF is given to you. You can simply calculate NPV at different rates and then do the interpolation the normal way. There is another shortcut way also. I'll just like to show it to you here. The shortcut way is like this for question number 4. Okay. Now this shortcut, children, is applicable only and only if the cash inflows every year are same. Now children, in this question, if you convert this 68,000 to CF80, you will get 109,400, okay, 109,400 as the cash inflow per annum. So can I say our initial investment PV of CO is 3,60,000 and cash inflow is 109,400 per annum for the next 5 years. I'll again repeat, how did I get 109,400? By converting this NPBT of 68,000, right? NPBT minus tax will give NP80 plus depreciation of SLM. You will get CF80 109,400. I'll just show it to you that since this 109,400 is per annum, every year same, you can easily calculate the IRR by a shortcut technique like this. At the rate IRR. Children, at the rate IRR, can I say NPV should be equal to 0? NPV should be equal to 0 means, can I say present value of cash inflow should be equal to present value of cash outflow. Do you agree with me? Now children, we know present value of cash outflow is 3,60,000 into 1. That is 3,60,000, and present value of cash inflow will be 109,400. Okay, 109,400 multiplied by PVAF of, now discounting at IRR, right? So IRR comma 5 years. So therefore, children, can I say PVAF of IRR comma 5 years will be 3,60,000 divided by 109,400, and this will come to 3.29. So we know one thing, that IRR, whatever that rate is, I don't know what the IRR is, but I know one thing about the IRR. Its 5th year annuity factor PVAF should be 3.29. So children, if you see the different PVAFs here, can you see at 16% it is 3.27, at 15% it is 3.35. That rate at which the PVAF is 3.29 will be the IRR. So children, can I say therefore IRR lies between, okay, IRR lies between 15% and 16%. I'll say here that IRR is 15% plus X. We will just make that number scale, okay, at 15%, this is 16%, this is IRR, somewhere in between. At 15%, the PVAF is 3.35. At 16%, the PVAF is 3.27. At IRR, the PVAF is 3.29. Everybody clear? So children, do you realize from 15%, if I increase the rate by 1%, that is 16%, can I say PVAF drops from 3.35 to 3.27. Everybody clear? So 3.35 minus 3.27. Children, this is 0.08 drop. But you wanted your PVAF to drop from 3.35 to only 3.29. So 3.35 minus 3.29 will be, I wanted a drop of 0.06 only. So therefore, for that, I should have increased the rate by how much? So 0.06 into 1 divided by 0.08. This will give 0.75. So basically from 15%, I should have increased the rate by 0.75 only, and therefore the IRR should be 15.75%. This is another way of doing it. Everyone clear? So with that, we complete the discussion to question number 4. So now children, moving on to question number 5. Question 5 is a capital rationing situation. What is the capital rationing situation? We have limited funds. So therefore, we cannot go for all these positive NPV projects. Okay, so what we are supposed to do? We are supposed to therefore create a project combination out of these that not only fit in our budget, but also give us the highest NPV, right? And that will be our final answer. Now to do that, children, there are two alternate assumptions. Now in this question, if you see, they are telling you assume that the projects are divisible. The other assumption is if the projects are indivisible. Now children, if the projects are divisible, you have to simply follow 3 steps. Step 1, calculate profitability index of each of the project. Step 2, rank the projects based on the profitability index. And step 3, select the top few ranks that fit in our budget. This is what you do if you go for the divisible one. If you go for the indivisible one, then children, you will have to do trial and error, where you will have to keep checking, okay, does project A with B with C fit in our budget? Okay, A, B and D, or B, D and E, and keep doing different trials and errors of different project combinations that fit in your budget, and then check out which of the combination gives you the highest NPV. That will be the answer. So children, I'll again repeat, for divisible project, no need to use your brains. Follow 3 steps. Step 1, use profitability index calculation for all of them. Step 2, rank the projects based on PI. And step 3, select the top few ranks that fit in your budget. That will be the best combination giving you the best NPV. But children, in case of indivisible, you'll have to do trial and error. Everybody clear? So with that, we complete the discussion to question number 5. Moving on to question number 6. Question number 6, children, is modified IRR question. As I told you, modified IRR, see children, this is your initial investment and this therefore becomes the present value. And then children, they have given to you the following cash inflows. Children, you have to take these cash inflows and keep reinvesting them at the rate 8% till you get one lump sum future value of cash inflow at end of year 5, correct? That will be your lump sum cash inflow at end of year 5. And then use the formula FV is equal to PV into 1 plus R raised to N, where FV will be the total future value of these reinvested cash flows, PV is the initial investment, N is 5 years. You can easily find out R. That R, children, will be your modified IRR. Everybody clear? So that was as far as question number 6 was concerned. Moving on, children, to question number 7. Question number 7, children, is a normal NPV calculation. Okay, present value of cash inflow minus present value of cash outflow. And children, some other techniques are also asked here. First of all, let me discuss about NPV. Can you see that this is your initial investment 6 lakh? Working capital also becomes an initial investment because you're investing today. But whatever working capital you're investing today, you'll have to recover at the end of the life, and that will become your PV of CI item also, right? So 80,000 into 1 will be your initial investment, present value of CO, but 80,000 into discounting factor, because that same 80 you will be recovering at the end of life will be in the PV of CI. Life is 5 years, children, no salvage. Okay, assume the depreciation is on straight line basis, great for income tax purpose. Now before tax cash inflows, children, cash inflows before tax is nothing but net profit before depreciation and tax. Okay, net profit before depreciation and tax is given. We will have to convert this to CF80, right? You have to convert this to CF80, find the present value. That will be your PV of CI. Tax rate is given to 35%, required rate 12%, and children, they're asking you to first of all calculate NPV. Now at the rate 12%, children, do you realize the discounting factors are also given to you? Everyone clear? You can easily find out the net present value here by doing PV of CI minus PV of CO. In PV of CI, children, there are two things. One is CFAT, correct? And one is the working capital recovered or released. In PV of CO, there are two things, initial investment and working capital invested, and with that you can easily find out NPV. Then children, they're also asking you to calculate IRR, trial and error you have to do. For that they have given to you a hint that IRR is lying somewhere here between 12 and 14 and 15%. Somewhere here they have given to you all the discounting factors. You can easily do the trial and error and find out the IRR here. Children, they are also asking you to calculate payback period. Now children, for payback period, a total initial investment, can I say, is 6,80,000. You want to check how fast this is getting recovered. Children, you know the table here, cash inflow and then cumulative cash inflow. Remember one thing in this, children, in the cash inflows, of course, we'll be taking the CFAT, but in the last year cash inflow, don't forget to add the 80,000 which is getting recovered. Everybody clear? So your initial investment is 6,80,000. Your 5-year cash flows are 5-year CFATs. In the 5th year CFAT, you should also add the working capital recovered. Had there been a salvage year, then salvage also would have been added in the cash inflow of year 5 to find the payback period. And discounted payback period, of course, it's the same as payback period with the time value of money, right? You will not be accumulating the cash inflows, you will be accumulating the present value of cash inflows. So with that, we complete the discussion to question number 7. Now children, moving on to question number 8. In question number 8, children, again, it's a normal NPV calculation question. Children, they have given to you two projects, A and B. This is the initial investment of A. This is the initial investment of B. This one here, 18 lakhs. And this itself becomes the PV of CO. Children, as far as A is concerned, cash inflows are 4 lakh per year. As far as B is concerned, 5,80,000 per year. They have given to you that life for both the projects are 5 years. So 4 lakh into PVAF is PV of CI minus 12 lakh will give you NPV. 5,80,000 into PVAF minus 18 lakh will give you NPV. With that, we get the NPVs for both the projects A and B. Correct? The discounting rate is of course 10%. So children, they're asking you as per NPV. They're also asking you as per PI method. So children, PI, what to do? Present value of cash inflows upon present value of cash outflows. For both, you can get the PI. And IRR, children, IRR, again, do the trial and error method, for which they have given to you certain hints here that IRR is lying somewhere near 18% and 20%. The PVAFs are also given. So with that, we can easily find out that rate at which the NPV turns out to be 0. That is the IRR. So with that, we complete the discussion to question number 8. Moving on, children, now to question number 9. Again, a normal NPV question, children. Here you can see that the initial investment is 400 lakhs. This is your PV of CO. Then children, they are telling you earnings before depreciation and tax, which means net profit before dep and tax for a life of 5 years is given. We can easily convert this to CFAT and calculate the present value. This will be PV of CI. So right now in PV of CI, you have CFAT. In PV of CO, you have the initial investment. Children, they are saying that cost of capital is 12%. Depreciation is on WDV basis. Children, whenever depreciation is on WDV basis, always remember that when you are doing CF80 calculation, you cannot do CF80 on a per annum basis. Here, of course, you can't do it because every year it is almost different year. Of course, 2 years at a time are same, but still you will have to do each of the 5 years separate, because if the depreciation is on WDV basis, every year depreciation will be different, every year tax will be different, and therefore every year CF80 will be different, and therefore you cannot use the PVAF. You will have to multiply each year CF80 by discounting factor. This is the first thing you should remember when you see WDV depreciation. The second thing you should remember when you see WDV depreciation is that there can be either a tax payment on STCG on the sale of asset after 5 years, or there can be a tax savings due to STCL, short-term capital loss, on sale of asset after 5 years. So children, WDV, always remember that. Yes, 2 points. What are the 2 points? First point is CFAT every year will be different. Second, there can either be a gain or loss on sale of asset, on which there can either be a tax paid or a tax saved. The scrap value at the end of 5 years may be taken as 0. There is no salvage. Income tax rate is 50%. You are required to calculate NPV. Everybody cleared? Actually here, if you see, there are only 3 items. One is CF80, one is initial investment, and one is the tax effect due to gain or loss. So with that, we complete the discussion to question number 9. Moving on, children, to question number 10. Question number 10, children, also is a basic NPV question only. Here they are saying that your initial investment is 80,000, life is 8 years, salvage at the end of 8th year is 6,000. So children, can I say in the first paragraph you got one initial investment of 80,000, one CI, right? A CI of salvage at the end of life. Then children, they are saying annual operating cost is 7,500 and the revenues are 40,000. Using this two data, you can easily find out CF80 for this particular question. So children, in the CI, now you have CF80, you have salvage. In the CO, you have got initial investment. Now they're saying presently this hospital is outsourcing this particular work and is earning commission of 12,000 per annum net of taxes. Basically, they are saying that, you know what, if you go for this particular machine that you are doing capital budgeting for, if you go for this particular machine, then what will happen? Currently, children, all the diagnostic work we are transferring outside and we are earning commission. Now we will not transfer outside and therefore we will not earn the commission, and therefore I hope you know this, that because of a particular project, if I am going to lose some income, that will go in the PV of CO of that particular project. Everybody clear? So always remember, there are two types of cash outflows. One is the actual cash outflow like 80,000. Second is the loss of inflow like 12,000. Similarly, children, there are two types of cash inflows. One is the actual cash inflow like this 40,000 or 6,000. And children, there is another type of cash inflow, that is a savings in cash outflow. Because of a particular project, if I am going to save some cash outflow, that savings in cash outflow will become a relevant CI for me. Yes, children, they are asking you, recommend based on NPV and profitability index. One is PV of CI minus PV of CO. One is PV of CI upon PV of CO. Everybody clear? So with that, we complete the discussion to question number 10. Moving on, children, now to question number 11. Question number 11, children, is a normal NPV question, but just remember the lives of both the projects are different. So therefore, when you have to compare the NPVs, you can't compare the NPVs because the lives are different, and therefore you will have to do the annualized gain calculation. What is the annualized gain calculation? Whatever NPV you get, you divide it by PVAF, right? So here in machine 1, whatever NPV we will get, we divide by PVAF of 5 years. In machine 2, whatever NPV we will get, we will divide by PVAF of 6 years, and then once you do that, what you get is called as annualized gain, and when you compare both, select the one whose annualized gain is higher. So can you see, this is the initial investment, discounting rate is there, tax rate is there, annual income before tax and depreciation, again NPBDT is given, we have to convert it to CF80. Everyone clear? We have to convert it to CF80. Depreciation in straight line basis. You are required to, children, now when they're asking you to calculate NPV and then advise the management as to which machine they should take up, please don't forget to annualize it. As far as discounted payback and internal rate of return is concerned, you know what to do. Nothing much to discuss here. Everyone clear? It's a straightforward question. So with that, we complete the discussion to question number 11. Moving on, children, now to question number 12. Question number 12, children, is like a missing figures question. Okay, nothing much here, children. They have given to you the IRR. They have given to you annual savings in cost, that is CI, right? Savings in cost is CI. So with these two numbers, we can easily find out the cost of the project. You have the initial investment, you have the annual CI, you can easily find out the payback period. Then children, can I say they have given to you the profitability index PI. I hope you remember this. PI is 1.064, which means this must have been discounted at the rate COC and not IRR, because if the discounting would have been done at IRR, then this would have been 1, correct? Children, 1 means PV of CI and PV of CO are same. But if it is 1.064, that means PV of CI and PV of CO are not same. Everybody clear? So children, with this profitability index, we can easily find out the present value of cash inflows at the rate cost of capital. We have the cash inflows, we have the present value of cash inflows. We can easily find out the cost of capital using these PVAFs. Everyone clear? If you remember correctly, 12% was the cost of capital. PVAF, children, here you can easily take a total year. Discounting factors are given, you can take a total year and find out the cost of capital. And once cost of capital is found out, children, do you realize you have the CI, you have the CO, you have the discounting rate, you can easily find out the NPV. Everyone following? So with that, we complete the discussion to question number 12. Question number 13 is a huge one, okay? Question number 13 is a big NPV question. Lot of points are there. Let's quickly go through them. First of all, children, do you remember that they are saying that you want to establish a new machine system here where you can take care of all the waste that is getting generated by some other project. Currently, children, this waste, we are getting it removed by a contractor by paying him 50 lakhs per annum. So children, net of tax, do you realize this 50 lakhs net of tax, do you realize you will save, right? You will be saving this money, because now if you go for this machine, you no longer need to pay the contractor. You will save these 50 lakh rupees into 1 minus T, correct? And that will go into your PV of CI. However, to terminate the contract, you have to pay the contractor 30 lakh rupees. This becomes a relevant outflow for this particular project. Then children, they are saying that this particular machine will be financed 200 lakhs by a loan. So children, do you realize, as far as your investment is concerned, you are not actually putting from your pocket. You are taking 200 lakhs and then you're investing 200 lakhs. So in PV of CI, I will show 200 lakhs into one loan received. In PV of CO, I will show initial investment 200 lakh into one. Either ways, alternatively, you can remove both of them because the net effect is same. Everybody clear? So either I show 200 lakh into one received as loan and then invested in the machine, or I don't show both of them, doesn't matter. But of course, the repayment of loan I will have to show, correct? 200 lakh divided by 450 lakh every year I'm paying. It will go in PV of CO by multiplying 50 lakh by PVEF. Everyone clear? Then children, of course, the interest rate is given to you 16%. Children, I am pretty sure you understand this interest will form part of the cash expenses in the operating cash flow after tax table that you will be making, because interest is an allowable expense. At the end of 4th year, machine can be sold for 20 lakhs and the cost of dismantling and removal will be 15 lakhs. Basically, children, do you realize net salvage value is given to you here? Everyone clear? Salvage value is given to you here. It will form part of your PV of CI. Then children, the whole data is given to you for calculating the CF80. These are your cash revenues and then some cash expenses are given. Children, don't forget to also include the interest here, correct? Interest also will be included here. Got it till here? Great. Now, as far as depreciation is concerned, can you see it is a WDV depreciation? Children, since it's a WDV, you're anyways going to make the CFAT different for all of the 4 years. But also, children, do you realize there will be a gain or loss on the sale of asset at the end of life, on which there will be a taxation effect? Everyone getting it? Then children, they are telling you that you need initial investment in working capital of 20 lakhs at the start of year 1, and then from end of year 1 onwards we want it to be 55 lakhs. So today I have to invest 20 lakhs. At the end of year 1, I have to invest additional 35 lakhs. This 55 lakh circle will start now of working capital, and at the end, children, the entire 55 lakhs will be recovered, thereby making the working capital zero. So there are two outflows as far as WC is concerned. Initial investment 20 lakh into 1, additional investment 35 lakh into discounting factor of first year, and then the entire recovered inflow 55 lakh rupees multiplied by discounting factor of 4th year, because you will be getting it a single future cash flow, one shot entire 55 lakh you will receive at the end of year 4. Then children, they are saying that, you know what, this particular machine we will be setting up in an area which would have otherwise been rented out, okay, which would have otherwise been rented out for 10 lakh per annum. That means, children, this particular area where we are going to start is rented out for 10 lakh per annum, or would have been rented out for 10 lakh per annum. So children, do you understand that if we take this entire area and use it for this project, we will not be able to rent it out, and therefore because of this project there is a loss of revenue. It will go in your CO, of course, net of tax. Then children, they're talking about labor costs. This is a very interesting adjustment. Labor costs include wages of 40 workers whose transfer to this process will reduce idle time payments of 15 lakh in year 1 and 10 lakh in year 2. What is the meaning of this? Children, can you see wages of year 1 and 2 are 75 lakh, 75 lakh. But what is happening is, for this particular project, I will be transferring some workers from some other project who are sitting there right now doing time pass, okay? And to them, I'm anyways paying money, and that is, can I say, classified as idle time payment. But for this new project, I will tell them now, stop the time pass, come here and work. And therefore, my idle time payment is reducing. But children, payment is continuing. Everybody clear? And therefore, you ask yourself a question. If you would have rejected this project, this payment of 15 lakh in year 1 and 10 lakh in year 2 to those workers whom you have transferred here, can I say you would have anyways done it? Ask yourself, if you would have rejected this project, would you have anyways paid them? The answer is yes, because we are paying them idle time. So as far as cash flow is concerned, this 15 lakh in year 1 and 10 lakh in year 2 cash outflow in form of wages to these workers who are right now doing time pass will anyways continue, and therefore they will be considered irrelevant for this particular project. And since they are saying that it is included in the wages, from 75 lakh of year 1 I will subtract 15 lakhs, from 75 lakh of year 2 I will subtract 10 lakhs, because they are anyways going to be paid and therefore they won't be taken into consideration, they won't be considered relevant for the capital budgeting of this particular project. Then they say factory overheads include apportionment of general factory overheads. Children, these factory overheads they are saying are nothing but apportioned overheads. Now children, apportioned overheads are some cost in the company which is anyways happening whether I go for this project or not. It is just a book entry where we are apportioning that cost to this project. So as far as this project is concerned, there is no additional cash flow, but they are saying except to the extent of insurance charges of 30 lakhs per annum. So what we will do is the entire factory overheads we will remove, and in this the insurance charges which is specific to this particular project, relevant for it, which wouldn't have anyways happened, it will happen only and only if you go for this project, that will be a relevant cash outflow for this project. Everyone clear? The company's tax rate is 50%. When you are doing the cash flows after tax calculation, this will be utilized. So with that children, we complete the discussion of this question number 13. Moving on children to question number 14. In question number 14 children, again it's a medium-sized NPV calculation question. 2-3 points you should know here. See, first of all, life is 8 years, that's okay. Here you are getting a tax-free subsidy from the government. It becomes an inflow for you today and therefore you will show it in the PV of CI. This is the initial investment outflow. Additional equipment will be purchased at the end of third year. So children, again an outflow, but you'll have to multiply it by the discounting factor of third year to get the present value. Then they are saying that the original equipment will have no resale value, but the additional equipment can be sold for this. So basically children, you will be getting one salvage of 1,25,000 at the end of 8th year, discounted for 8 years. But because there are two different machines here, you will have to do two different depreciation calculations. Everybody clear? When you are doing the CF80 calculation, two depreciations will be there. One on the original machine and one on the additional machine. Working capital 20 lakh children, you have to invest working capital today 20 lakh. 20 lakh will get recovered at the end of the 8th year. Then children, they have given to you all this data about CFAT. Normal CFAT calculation is there. It is just that here, children, because we are following SLM depreciation and because years 4 to 5 and 6 to 8 data per annum is same, you need not show 4th year separate and 5th year separate, 6th year, 7th year, 8th year separate, no need. Between 4 and 5 per annum will show, between 6 to 8 per annum will show, and then while discounting will multiply by the PVAF of 4 to 5 years, and for this last column 6 to 8 years. Everyone clear? The PVAF calculation. Children, but remember one thing, when you are doing this 4 to 5 or 6 to 8, don't club 3 years, okay, or 2 years here. Do it on a per annum basis. But when you're doing the discounting, you multiply by PVEF. Yes, and one more thing here, children, if you note this particular line, the loss of any year will be set off from the profits of subsequent years. This is carry forward and set off of losses. In one of the years, you will be getting a net profit before tax negative, right? A loss. And children, that net profit before tax is nothing but profits and gains from business profession head, right? It's a loss under that head. And that will be, children, carried forward to the future years and set off against the profits of the future years. And therefore, in the year in which there is a loss, there is no tax to be paid. And of course, the tax calculation of the future years in which you are going to be setting off this loss has to be calculated correctly, okay? So therefore, please be alert as far as the loss is concerned. Carry forward of loss in this particular question. Apart from that, children, nothing special here, okay? So moving on, children, to question number 15. Question number 15, children, is again a mutually exclusive two projects given to you or two machines given to you. Machine A and machine B, you have to select any one. But children, here you have to do the calculations based on annualized cost. What is the annualized cost? First of all, understand they have not given to you the cash revenues. For machine A, they have given initial investment and they have given the annual operating costs, the cash expenses. Same data, children, for machine B also. So therefore, you can maximum calculate the net cost of the project. But because, children, do you realize that both their lives are different? Can you see 3 years for A and 2 years for B? You'll have to divide them by PVAF to find out the annualized cost. and then select the one whose annualized cost is lower. Everyone clear? And when I say calculate net cost of project, basically it is nothing but to calculate the present value of net cash outflow. So whatever cash outflows are there, calculate the PV of it, and children, that is nothing but the net cost of the project, because here children there is no salvage or any other sundry cash inflow given. There is absolutely no cash inflow given. So there are only two outflows, initial investment and the cash expenses. Calculate the present value. That becomes the present value of net cash outflows divided by PVAF. Because children, the lives are different, calculate the annualized cost and then select the one whose annualized cost is lower. Moving on children to question number 16. Question number 16 children is a replacement decision question. Replacement means what children? You already have one machine, correct? You already have one machine. It has got few years left to run. You are thinking of replacing this with a new one. So children, this entire question number 16 is about the replacement. Here children, they are saying initial investment of the new machine is 60 lakhs. Then they are saying that the current production is 80,000, which means children, if I continue with my existing machine, I will be able to produce and sell 80,000 units. But if I go for the new machine, then 1 lakh units. Children, all of this will be forming your complete calculation of CF80 for both the machines in that incremental cash flow model, correct? Children, selling price will remain same. Then all this data is given to you for the cash expenses as far as the CF80 is concerned. Of course, allocated corporate overheads will be ignored. Then children, why are we ignoring allocated corporate overheads? Because the cash flows are anyways happening in the corporate office, right? These are just allocations, so irrelevant cash flows. Then they're saying the existing machine has an accounting book value of 1 lakh. But children, accounting book value is irrelevant for us. We want the book value as per the income tax. And as per income tax, they're saying the existing machine is completely depreciated, which means the book value as per income tax of the existing machine today only is 0. Everybody clear? And therefore you will not be able to take any depreciation while you are calculating the CF80 for the existing machine. It is estimated that the machine will be useful for 5 years. The supplier of the machine has offered to accept the old machine for 2,50,000. However, the price outside today is 150. This 150 I will ignore because I am getting 2,50,000 from my supplier only. So therefore the old machine, if I go to sell outside today, I will get 1.5 lakhs. If I sell it to the supplier of the new machine, I will get 2.5 lakhs. So obviously I'll go for 2.5 lakhs. Yes, the old machine, if I continue children, then it will give us 35,000 after 5 years. This will be used when you're calculating the incremental salvage after 5 years. New machine also life of 5 years, salvage of 2,50,000 after 5 years. So children, the incremental salvage will be 2,50,000 minus 35,000 after 5 years. Tax rate 40%, depreciation SLM. Okay, opportunity cost is 15%. Should you go ahead with the replacement or not is the question. Calculate the incremental NPV. If the incremental NPV is positive, you should replace. One thing you should understand here children, that in replacement decisions, when you're selling the existing machine today, do you realize because you're selling it midway of its life, there is a possibility that the sale value and the book value of the existing machine today is not same, and therefore there can be a short-term capital gain or a short-term capital loss. In this particular question, if you are selling this existing machine today for 2,50,000, the entire 2,50,000 children will become a gain because the book value of this machine is anyway 0 today, right? So when you sell it for 2,50,000, there will be a gain children on which you will have to pay tax. Everyone understanding? So that tax effect will also be there in this entire calculation. Moving ahead children, moving ahead to question 17, a very simple replacement decision question. Again, they are saying that there is a machine which is already in operation for 3 years. 8 years is pending. After 8 years, no salvage in the end. Currently, if I go to sell it, I will get 2 lakhs. Children, this is in case of replacement. If I sell the existing machine today, I will get rupees 2 lakhs. Of course, the cost of the existing machine 3 years back irrelevant. New machine, children, can I say 10 lakh I will need to pay, but because I will be getting 2 lakhs also, net investment is only 8 lakhs. Then children, all the data given for CF80. Yes, a very, very basic question given here children as far as replacement is concerned. Always remember in replacement you have to calculate the incremental NPV. And also children, remember that even if there is SLM depreciation, when you are selling the existing machine today, there is a possibility of a gain or loss on which there will be a tax effect. Got it? Moving on children to question number 18. In question 18, children, it's a normal question. You can see this. This is the initial investment of X and Y. Again, mutually exclusive machines, okay? Initial investment for both X and Y is given. Life, children, of both the machines are different. Then children 1, 2 and 3. These are your cash expenses, and then savings means cash revenues. So children, cash revenues, cash expenses, you can calculate CF80. So you have the initial investment as an outflow, you have the CF80 as an inflow. Of course, while calculating CF80, you will also be getting NP80, right? And therefore, they're asking you to first of all calculate the ARR for both the machines. And then present value index means profitability index PI, PV of CI upon PV of CO is to be done in this question. Very, very simple question, question number 18, right? Moving on, children, to question number 19. Question number 19, children, is about one machine only, but we are thinking that when I start operating on this machine, what should I do in the future? What should I do in the future means basically, children, here there are two options. Either you service a part of the machine at the end of year 1 and it will then continue for a total of 3 years, or if you don't want to service, then you'll have to replace a part of a machine at the end of year 2. And then, children, that machine will continue for a total of 4 years. So that same machine, children, two different options are there in this question. A normal NPV question, nothing much to be done here. Okay, so you can see its initial investment is 50,000. Cash flows 18,000 per annum for 3 years. If we service the machine part at end of year 1 for 10,000. Yes, and then you will get a salvage at the end of year 3 of rupees 12,500. Alternatively, children, you can replace the machine part costing rupees 15,500 at the end of year 2. In such a case, 4 years this machine will run. It will give you 18,000, one more cash inflow at the end of year 4, and then salvage at the end of year 4 will be 9,000. You have to calculate NPV for both. Children, here in the first option, the NPV is negative. The second option, the NPV is positive, so we straight away go for the second option. No need of doing any annualization here because one is 3 years, one is 4 years. But there is no need of doing annualization, no need of dividing by PVEF because one is a negative NPV, right? One is a positive. Straight away go for the positive NPV option. Everyone clear? Of course, then children, they are also putting one line. If the supplier gives a discount of 5,000, children, if the supplier gives a discount of 5,000, your initial investment of both options, children, will reduce by 5,000. If the initial investment reduces by 5,000, the PV of CO will reduce by 5,000. If PV of CO reduces by 5,000, NPV will increase by 5,000. So whatever NPVs you have already calculated, just add 5,000 to both of them because, children, this initial investment is common, right, for both the options because it is the same machine. Everybody clear? So add 5,000 to both the NPVs. Of course, the answer won't change. The answer will still remain same. Everyone clear? This was question number 19. Moving on, children, to question number 20. Question number 20, children, is an illustration from a study material. Basically, they are saying that, see, they have already calculated the NPV. A's NPV is there, B's NPV is there. But can you see A's life is 6 years, B's life is 3 years. So basically, they're asking you which project should R PLC, this company, accept. You cannot take a decision based on NPV. You will have to divide it by PVAF to find the annualized gain and then select the project whose annualized gain is higher. That's it, children, in this particular question, question number 20. Now, children, moving to question number 21. Question 21 is again a normal NPV question only, where, children, there are two mutually exclusive projects or machines. Okay, here machine A and machine B. Can you see here machine A and machine B? They are saying you have an existing machine, you want to get rid of it. You are now wanting to know whether you want to go for machine A or machine B. Children, a very, very, very straightforward net present value question. See, both are having initial cost of 5 lakhs. Salvage value of the old machine is 1 lakh, which means if you sell the old machine today, you will get rupees 1 lakh. Now, there are some spare parts of the old machine which are there. They can be used if the company purchases A. No additional cash flow for that. So, if you go for A, you can use the spare parts of the old machine, but extra spare parts you'll have to buy is of rupees 1 lakh. If you go for B, you will not be able to use the spare parts of the existing machine and therefore you will have to buy them for rupees 2 lakhs. Of course, you can then sell them for 0.2 lakhs. It will be a relevant cash inflow for B. Then, children, the CFAT data is given. Salvage of A, salvage of B. Very, very simple, straightforward net present value question. Apart from NPV, they are also asking you discounted payback, and desirability factor means profitability index. One thing, children, when you are calculating discounted payback, you can do this. In the initial investment, children, you should take all the cash flows that are happening today. the initial investment of the new machine, sale of the old machine will be subtracted, additional utilities purchased will be added. Everyone understanding everything happening today, take it into consideration for the initial investment. You will get the net initial investment, and then in the coming 5 years, all cash inflows will be taken into consideration, not only CFAT, but also the salvage that you will be getting at the end of the 5th year, added to the cash flow of the 5th year, and you will be able to find out the discounted payback period by making the table year, cash inflows, discounted factor, present value, cumulative present value. Everyone clear? So with that, we complete the discussion to question number 21. Question 22, children, is a fun game. It's just normal question, children, nothing much to do here. They have given to you the PV of CO, they have given to you the PV of CI. Everybody clear? And children, they're asking you which combination would you want to go for. Yes, children, so if I go for combination 1 and 2, then what will happen? Children, combination of 1 and 2 means this is the PV of CO, this is the PV of CI. PV of CI total minus PV of CO will give you the NPV. If you go for 2 and 3, then children, do you understand this combo of PV of CO, this combo of PV of CI? PV of CI minus PV of CO will give you NPV. If you go for combination of 1 and 3, then you know what to do, correct? 1 and 3 total, 1 and 3 total, you get total NPV. Children, of course, there is one thing here, that when you go for combos, there might be synergy benefits. Yes, in some of the combos they have given synergy benefit. Children will take those synergy benefits into consideration. For example, they are saying the total investment required for 1 and 3, which means if you combine 1 and 3, children, can you see? If I combine 1 and 3, total investment is how much? 4,70,000, right? But they are saying combined it will be 4,40,000 only. So no problem, 30,000 you are saving here. So all such things they have given to you, and children, you have to find out the best project combination which gives you the highest NPV, correct? So 1 and 2 is one combination, 2 and 3 is another combination, 1 and 3 is another combination, 1, 2 and 3 also is another combination. Children, whichever gives us the best NPV, we'll go for that. Everyone clear? This was as far as question 22 is concerned. And children, as far as question 23 is concerned, it's like a cost of capital question combined with capital budgeting. They are saying that this is P0, this is D0, this is the growth rate. Using all this data, we can easily find out the KE. Everyone following? Then they're saying currently it is evaluating a project requiring funds of rupees 20 lakhs. This is your initial investment, and cash flows after tax annual CI is 10 lakhs. So children, 10 lakh into PVAF of 3 years minus 20 lakh into 1 will give you NPV. But then what is the rate at which you should calculate the PVAF? They are saying find out the NPV if it is financed from retained earnings. No problem. Whatever KE will get, we will assume it to be KR and use it as discounting factor. Then they are saying it is also possible that you are financing your entire project by issuing fresh equity at market price with a flotation cost of 5% on the issue price. No problem. Children, this is the issue price 180 minus 5%. Children, you will get the net proceeds. Recalculate the KE at the net proceeds. KE is equal to D1 upon net proceeds into 100 plus G. And using that new KE, children, you will again calculate the PVAF, multiply by 10 lakhs to get the PV of CI minus PV of CO will give you the NPV for question number 23. Everyone clear? Two different NPVs are there. So with that, children, we complete the discussion, the brush through of the entire chapter of capital budgeting. I hope you all have benefited from it, and I wish you all the best. Thank you so much.